We want to continue our conversation on the role of the Federal Reserve. And I think it's a fair statement to say that after the financial crisis, the Federal Reserve has become bigger and more powerful with different and more oversight over the financial services industry. Is that a fair statement?
I think it is a fair statement. There was an effort by Congress for a while to diminish our powers, particularly when Dodd-Frank was being debated. But by necessity, our powers have been expanded. The financial system is uber complex. And again, as was discussed earlier, we're one of the regulators, but we also set monetary policy. I don't think you can separate the two. You have to know your customer, or basic rule of banking, in order to make policy for the country and have responsibility for financial institutions of all sizes.
And I guess you also have to evolve based on the set of circumstances around you. So talk a bit about the role of the Federal Reserve post the financial crisis and how things have changed.
Well, I think that, the main goals in monetary policy really haven't changed. They're maximum employment and stable prices. We talked about that in the earlier sessions. But the Federal Reserve and many other central banks around the globe were faced with extraordinary circumstances during the financial crisis, the recession, and the recovery. We lowered, as did other central banks, we lowered the short-term interest rates all the way to zero. And one thing that Milton Friedman taught us, expert on studying the Great Depression, was monetary policy needs to do even more than just lowering interest rates to zero. When you're in a severe situation like we were in, you need to add more monetary accommodation. So one of the things that we had to do was do the quantitative easing that was discussed a lot this morning. By the way, I'll just quote Milton Friedman from 2000 when discussing Japan's bout with deflation and stagnation in that country. He said, well, is there anything they can do? They've already lowered interest rates to zero. And he said, sure, they can buy long-term government bonds in order to increase money growth, in order to get the economy going. So what we were trying to do, which was very different for us, as people talked about this morning, we did do new policies that we hadn't used before, but they're exactly the textbook policies that you need to do when you're in circumstances like this. We also became, I think, more transparent and more accountable to try to help the American public understand what we're doing. We are given this very privileged position to make policy decisions that affect the whole country, in fact, the global economy on our own. So I think it was really important that under Chairman Bernanke, it became much more transparent, much more accountable to the public. And we've had to take these extraordinary measures because this is what was needed given the economic circumstances we're in. But I will comment on one thing that was missed this morning. We're actually basically moving towards normalization now. This is not a permanent shift in monetary policy. Now that the economy is getting better, we're tapering our purchases. We'll bring that program likely to an end later this year. And obviously, we're thinking seriously about the time is coming, probably next year or so, when we're going to start raising interest rates and coming back to a more normal policy. So these extraordinary measures we've taken, which were controversial and challenging, were exactly the right thing, but they were the right thing for the circumstances then, and as the economy's improved, we're now able to move back to more normal policy.
Can I comment on, I think there's a little confusion as to what the role of the central bank is, and particularly when you examine the emergency steps that were taken. I like to say that we just modernized the playbook as it was written after the Panic of 1825 and so on by a fellow named Walter Bagehot, B-A-G-E-H-O-T. And under Ben Bernanke's leadership, as a great historian, financial historian, economic historian, we brought it into the modern era. And to be sure, we took risk. And there was quite a good deal of criticism of what we did. But when the economy grinds to an entire halt, and most importantly, the fuel supply, which is money, and the money markets, remember what happened? The commercial paper market failed. The first money market mutual fund established in the United States broke the buck. Interbank lending ground to a halt.
The largest companies in the world were worried about
You cannot
payroll,
finance an
like
economy
GE.
unless you have the fuel, and the fuel is money. So we did step in. I do want to take this time, not only because he's here, but especially because he's here. I think Ben Bernanke deserves an enormous amount of praise, not just for the ingenious way which he cobbled together what we had to do with the input from everybody that he could access within the Federal Reserve, but the decency with which he conducted it. An extraordinary, decent man. And you have to remember the following. When Paul Volcker was chairman, no one knew what the decision was taken by the FOMC, speaking about communications. And then when Ben's predecessor, Mr. Greenspan, spoke, it was, you know, I like to say, oracular circumlocution. Nobody understood what he said. And it's very important for us to communicate in order to give market signals of where we're going. There was some criticism of that earlier. This gentleman opened it up to the public. And when you open up to the public, you are subject to criticism. There are more opinions. But I think it's a great contribution to central banking, and we're continuing to do that.
You're absolutely right. Thank you very much, Dr. Bernanke. And we know that we'll be hearing from you. Of course, we'll be hearing from Ben Bernanke shortly after our panel. And with all of that, with the unbelievable innovation that you and colleagues at the Fed have come up with, and this more open communication, the debate rages on whether or not the tools are almost done, and whether or not the Federal Reserve will be able to do anything else from here. We heard so many comments about fiscal policy in the last couple of panels. Kevin Brady saying, look, when Janet Yellen is out there at the Humphrey Hawkins, she should say, it's on you now. And Kevin Warsh saying similar things. Why hasn't this message resonated?
It's Congress. Look, again, going back to Chairman Bernanke, he used to make this part of his constant commentary. And then individuals within the system like me and John and others have made the same comments. We are necessary, but we're not sufficient. I'll liken it to the following. We can fill the gas tank, provide the fuel for the economy. That's money and the credit system. We cannot incent people to step on the gas pedal and drive job creation and CapEx forward unless they have the right incentives. What will their taxes be? What will the spending patterns be of the federal government? The regulatory morass that Mr. Friedman spoke about and others spoke about. So we're critical, but people have to be incented to use what we provide and use it in a way that drives the economy forward. And they're the choke point right now. So we have the foot on the gas pedal, they have their foot on the brake. And I agree, again, I want to talk about the central bank, as does John, that's our job. But they're the ones that are really holding back the economy, in my less than humble opinion.
And all of the members of the Federal Reserve bring different mentalities, different experiences from your various parts of the world and districts of the world. Let's talk a bit about San Francisco, about California, and about Dallas, and about Texas, and what you're seeing today, and why we have such discrepancies in terms of unemployment being low here and being higher in other areas of the world, including California.
Sure. I'll go first, be happy to go first. Obviously, California and other parts of my district, like Arizona, Nevada, were some of the hardest hit parts of the housing crash. We were big parts of the housing boom of the 2000s, and we got hit really hard from the housing crash. So it's absolutely true that we still have high unemployment in certain areas of our district. That said, I also have states like Utah, Idaho, and Washington that are booming. But I will tell you something that you see on the West Coast, and I think you see across the country too, is the economy is improving. We are adding jobs. We are seeing growth. And if you're in the Bay Area or if you're in Seattle, this is a economy that's booming beyond belief. One of my friends who's been in commercial real estate for many decades has basically said to me recently, San Francisco is the hottest market in San Francisco he's ever seen in his whole life. And it's driven by technology, innovation, new ideas. Some of them seem kind of crazy to most of us, around the social media. But in fact, these are people creating new jobs in the future for the U.S. economy. And so what I see is a lot of optimism. I see a lot of the future is ahead of us and is better. And quite honestly, I see, confidence in the U.S. economy. And I think, from a monetary policy point of view, I see my job and our job is to keep this economy on track, keep inflation low and stable like we were talking about. And again, I agree with Richard. It's up to the economy to create the growth. It's up to the economy and the policymakers to make those right decisions. But we need to set the baseline for that. And again, what I'm seeing out there is quite a lot of optimism and energy in the economy right now.
John and I have begun to worry. We've begun to think alike. It's absolutely frightening. Yeah. But there are 26 states now that have unemployment of less than 6%. Some are in his district. Of course, we're very fortunate here. Our unemployment rate is 5.2%. And the two states have been the biggest job creators. Obviously, by virtue of size, California is the biggest state in the union. Texas has been a bigger job creator, but it's still, I don't want to be competitive here, but still,
You should, because he is also.
we have by virtue of size. And then Florida comes in third, incidentally. If you look, then it trails off, because a lot of states are much smaller. Now, here's the interesting question for me. We have the same monetary policy in Texas as you have in New York or Michigan or Illinois. Yet we have dramatically lower unemployment and enormous job creation. So same interest rates on commercial industrial loans, same mortgage rates, et cetera, et cetera, et cetera. Same supervision and regulation of banks. So what distinguishes the difference?
Is that an energy story, or is it beyond energy?
Energy is 2.5% of Texas employment, and that includes the support services around it. Agriculture is 1% like it is for the rest of the country. No, we're a very diversified economy, as is the California economy. But I think it has to do with, again, at the margin, the difference in fiscal policy. And therein lies a big difference between California and Texas. We have the same monetary policy, but we have limited government here, much more business-oriented. Whether they're Democrats or Republicans in our state legislature, it's mostly Republican. But setting parties aside, we've taken advantage of this accommodative monetary policy here and driven the economy much more aggressively. And I think it's because there's less regulatory interference and enormous fiscal local incentives. But they cannot offset the really drawback part and the break part of the U.S. fiscal disincentives and regulatory disincentives. But to an extent, it's an offset. And I think that's helped us outcompete, outgrow, create more jobs. Again, the same price stability we're seeing throughout the rest of the country.
I want to get John's take on this, but also then I want to come back to you and say what's most onerous elsewhere that you're seeing. John, why don't you comment on that?
And what's the most?
On the fact that he's talking about fiscal policies, he's talking about Dallas and regions here that are actually doing much better when you look at the employment situation.
Well, again, I actually am basically an optimist and see, positive developments in all the parts of the country, in my part of the country, Texas. Again, we're kind of digging out of a deeper hole. Texas, to its credit, did not have a housing boom or crash and isn't having that experience. But job growth is actually quite strong in California. I mean, clearly there's going to be reallocation of capital and resources across states, and I actually think this experimentation, if you will, of different fiscal policies, different approaches across states is healthy. It's a great way to, to learn what policies work the best. But what I do not see a static, sluggish economy out in my part of the country. I see a dynamic, actually exciting economy. It's a different kind of economy. It's one that's quite honestly moved away from manufacturing, moved much more to high-tech, biotech, knowledge-based economy. But again, I would really, over the medium, longer term, we don't have any kind of structural unemployment problem in the West. We don't have any of these issues. It's really more the dynamic of getting out of the housing crash, and the economy is moving ahead. So, I'm not disagreeing about different policies. Some may be better or worse, but really my view is, our economy is doing really well in a different way.
And I share that optimism, by the way. Since we're seeing what happens with that wonderful horse from California and its nose strips, and whether they'll let it complete the Preakness.
That, by the way, is a regulation they do.
I really do feel that there have been positive benefits to the monetary policy that's been engineered. I've been a critic internally, as you know, but we have to confess, our U.S. corporations have the strongest balance sheets they've had, at least in my lifetime of 65.
But they're not spending the money.
They're not spending it on job creation because, again, who incents them to do that? Again, we provide the fuel. They've restructured the liability side of their balance sheet, also the asset side of their balance sheet. They've driven productivity to the max. So what I like to say, I used to say that we're the best looking horse in the glue factory, and I don't think that's a good analogy anymore. I like to think of us as Secretariat that's being held back by the gate. I have no doubt in my heart or my mind that the U.S. economy can outperform anybody. We no longer hear about the death of Anglo-Saxon capitalism. Europe is better. China has a better model. We are the best. We just have to let them out of the starting gate. We provide the means, the feed for the horses, but they won't run unless you open the starting gate, and that's where Congress is holding us back.
But you see companies like Pfizer wanting to relocate its headquarters abroad and take over AstraZeneca to get a better tax rate. I mean, this money is mobile. And you are seeing a capital flight out of certain states. You can say it's a reallocation of capital and it's healthy, and yet it's not healthy for the states involved that are losing that capital, right?
May I just make a comment, John, on that?
Sure.
We have a different world than we had before. We have a globalized, cyberized world. My entire life, was under threat of mutually assured destruction before the Cold War ended. We got the world we wanted. Take down the wall. Mao's dead. Ho Chi Minh's gone, et cetera. So what we have now is mutually assured competition for capital. It's free to flow. That's exactly what we fought for. And that's why it's important that we update our tax spending laws and so on. All central banks around the world are being accommodative right now. But the question is, now you can take your capital, and you're required to do so if you're a CEO of a publicly traded company, or by your bankers if you're a private company, to earn the maximum return on investment possible. And they will go where they get the best terms. And that's the new competition. And that's what our Congress needs to figure out. I think you'll find, whether it's Agustin Carstens in Mexico or anybody else, monetary policy is fairly uniform around the world. The difference is fiscal incentives. And that's what will determine where capital is distributed.
Let's talk about monetary policy around the world, because this is, at the end of the day, a global story. How does the Federal Reserve ensure that you are committed to the role of the Fed, but not impacting other economies? Throughout this last several years, during QE1 and 2 and 3, you've heard criticism from some of the emerging markets about the impact of Fed policy on their currencies and on their growth potential. How do you ensure that you're doing your job and not impacting someone else across the world in a negative way?
So I think, the fact of life is we are in a global economy with global financial markets, and obviously the United States is the biggest economy in the world. So when the Fed took dramatic actions, it clearly had effects on the global economy. I think that the main point to make is during the global financial crisis and the global recession, the policies we were taking along with our partners around the globe, whether in Europe or Britain or Canada, was all working together to strengthen the global economy. Low interest rates promoting growth basically creates a stronger global economy, less risk of Great Depression 2.0, and in the end, for emerging market countries, which are the ones who mostly were criticizing us, a strong U.S. economy, a strong European economy, a strong Japanese economy is in their interest, because what do? They sell us their products. So I think the first argument I would make is our policies, working closely with our other countries around the globe, we're strengthening the global economy, avoiding a Great Depression 2.0, and that's in the end very beneficial to them. Now the experience of last year was somewhat different. Here was the Fed starting to move gradually towards talking about tapering and normalizing monetary policy, and clearly that created a lot of tumult in global financial markets and some dislocations there, especially in countries that had some problems with their fundamental fiscal and current account status. So one of the lessons for us is not that we shouldn't do the right policy, is that we really need to be careful in how we communicate that, and when we do the policy of the taper that we've done, that we engage that in a very predictable, very gradual way, so the financial markets aren't spooked or maybe surprised, and they understand that. So if I would look at say a thermometer of how much we hear criticism of the Fed's tapering, for example, almost all of that was before we actually tapered. Once we actually instituted back in December the policy shift to start the taper, now we've done it 4 times, there's been very little volatility in the markets, a pretty good understanding based on my conversations with my counterparts in other central banks of what we're doing and why we're doing it. And so again, I see the lesson there is we need to double down on clear communication, explain what we're doing, and act in a very predictable manner.
We have a good example of a country that has done things right during this period, Mexico. And then there are other examples of countries that have not done things well. And I liken it to these low interest rates, this prolonged period of significant global monetary accommodation, not just at the Federal Reserve. You had an opportunity. You got cheap credit, abundant liquidity. It's like giving someone a credit card. If they go out and blow it on having a great party and just consuming, they don't do as well as those that go out and restructure and invest in the future. Mexico has invested in the future, and I think Agustin deserves an enormous amount of credit.
Absolutely.
And I don't want to pick on anybody, but I'll take an extreme example at the opposite end, which is Brazil. Wasted an enormous opportunity. Poland has used it to restructure. Poland's one of the great little economies in Europe, not so little. So it's really a question of whether or not you use money wisely or you don't. Our corporations have been using money wisely, in my opinion. Are they creating enough jobs? We'd like to see all of us as Americans more jobs created, but again, that's according to the incentives that they get. But I do think you have to differentiate I remember very well the Brazilian finance minister being so negative about our monetary policies going into this, and then turning around and being negative as we're trying to taper it back. It's just a question of whether you use money efficiently or not. We've given the world opportunity to do so, and some people did take advantage of it. Mexico's a prime example now, and the changes that they're making, very brave changes. Others have not. So the last thing I think you need to remember, and you had an example of it earlier, we are all commissioned by our diets, our congresses, our parliaments. The Bank of Japan is the Bank of Japan. We're the central bank of the United States. The Bank of England is the Bank of England. The European Central Bank, unfortunately for them, has 18 different countries. And we do get our licenses from them. And I believe is the most powerful economy in the world, the most important economy in the world. First of all, we have to bear that in mind. That's what gives us our independence. And secondly, if we do well and get it right, the rest of the world will benefit.
But what's the impact of some of those developing economies like Japan, like the ECB, doing similar policy as the United States, creating a world where we're all looking at lots of liquidity and rock bottom interest rates? What's the impact of that longer term?
I'll let John answer that.
Well, long term, hopefully, the impact will be economies that have low inflation and are actually back on track. I do think this issue of globally low interest rates, especially now that we're over 5 years into essentially zero interest rates, in terms of reaching for yield, we talked about that this morning. We talked about leverage loans a little bit. I mean, these are these are issues that we have to take seriously. We spend a lot of time at the Federal Reserve looking at, are we seeing signs of excesses in these various markets? Are we seeing signs of, how the carry trade and reach for yield are actually affecting financial conditions and how financial institutions are positioned regarding that? So I think, we take that very seriously. We study it very carefully. And as was discussed earlier today, our regulatory agencies have actually put out guidance and strengthened that guidance around the banks to make sure that they're watching this carefully and that we're not allowing, a bubble to form in our financial system. So I do take seriously the fact that, there are some trade-offs to having extraordinary monetary accommodation globally. We take those into account. We try to balance those. In fact, when some people criticize, I think on the other side of the spectrum, why aren't we doing more? Why aren't we doubling down on QE infinity or QE 7 or 8 or something like that? The answer is because you do the cost-benefit analysis. A little bit more QE may help the economy, financial conditions a small amount, but it also adds to some of these financial stability concerns I have down the road. Now, I'm not saying I'm worried about this right now that we're about to have a crisis. I agree with Steve Friedman's comments earlier, but we do have to be monitoring this and really taking seriously the fact that our extraordinary policies today could have some adverse consequences down the road.
Friedman made a very good point earlier. I would urge everybody in this audience, go out and get a copy of McKay's book written in 1841 about extraordinary madness and delusions of crowds. And he has a quote in there, you'll appreciate this, a woman. He says, men think in herds and respond that way. And we do, and you see that. We're not going to prevent future financial crises. We can temper them. And I don't foresee one in the immediate future. But it's very hard to see something coming down the pike. Our eyes should have been more open. We should have been more aware. We had sort of before Chairman Bernanke, we had more of a hands-off approach to financial regulation. That was guided by the philosophy of the former chairman of the Fed, Alan Greenspan. But don't underestimate the power of men and women to be driven by greed and gain to overshoot. Markets always overshoot. Markets are manic depressive mechanisms, often run by manic depressives. So I just think we have to be wary about that. That's the nature of the business. I used to be in the business, and I was on the other side. So, of course, you want to push things to the limit that you can. But we are more involved now in understanding financial stability. We spend a great deal of time talking about it. And there are certain sectors of the market that have raised some concern, and we're monitoring them carefully.
Well, you can't necessarily anticipate, where the next collapse or bubble might be, but you have to anticipate your actions. And here we are, and it's a perfect opportunity to be focused on monetary policy as we anticipate the end of what has been something none of us have seen before, and this experiment. So how do you anticipate whether or not you will see inflation? You've said we are already seeing inflation in some corners, or whether or not the balance sheet has become too big. What happens to a $3 trillion balance sheet after you're holding all of these securities? I mean, how do you unwind it? And how do you ensure success?
I'll go first. I mean, this is a sure success. I mean, this is the dream of every central banker to have this nice soft landing and everything to go smoothly, and that never happens. And given the extraordinary measures we've taken and the size of our balance sheet, it's going to be harder. So I agree with all the comments that we heard that it's going to be more challenging. I will also say that we've spent the last several years thinking hard about these issues. We've been testing tools in the marketplace, including the reverse repo facility that's gotten some press recently, where we're actively testing these policy tools that will help us raise interest rates and control interest rates when we do start to normalize policy. We've thought carefully about how we will bring the balance sheet over time back to more normal levels, and we've tried to communicate that in both in a 2011 statement that was in the minutes, but also in public commentary. I don't think it's going to be easy. I don't think it's ever easy, and it won't be necessarily smooth. We learned that last year from the taper tantrum. But I think we have put in a lot of effort to make sure that we know that when it's appropriate for the U.S. economy to raise interest rates, that we can do that we can manage the balance sheet over time and bring this economy, back, keep it, to full employment without creating extra inflationary pressures. Now, let me push back a little bit on the inflationary pressures. I mean, this has been the concern from the beginning. As a central bank, it's natural for us to be worried that we might be creating inflation. If you take Econ 101, $4 trillion balance sheet looks, like you've increased the money supply a lot and potentially creating inflationary pressures. Over the past 5 years, inflation has been very low in the U.S. It's been very low in Europe. It's been very low in Japan and other countries because of the economic situations we're all suffering through. So in my view, inflation is not the concern. We've actually done an amazingly good job of avoiding deflation, and we also have a very strong, ready-to-implement plan to raise interest rates and slow the economy to make sure the inflationary pressures don't build. So, obviously we think a lot about inflation and we talk a lot about inflation, but if anything, the problem that we and most advanced economies in the globe today are facing, I just got back from a trip from Asia, is too low of inflation. And I just wanted to make one comment about spending several days in Japan. Hopefully, they have now just leaving a period of 2 decades of deflation. Period where monetary policy was not able or chose not to act as aggressively as needed to avoid deflation. Finally, they've made some changes in policy, very dramatic changes now, after 2 decades of deflation that I think hopefully will be successful, and we're seeing some inflationary pressures. When I compare that to what the Fed has done, is we've acted aggressively early, we've kept those actions in place as needed, we've never allowed deflation to occur. We've also avoided the need late in the game to basically double down on creating new policies. So I view again, I think we have an exit strategy. I know we have an exit strategy. We're ready to implement it as appropriate, and we won't allow inflation to take off.
I think of this as a 4-act play. And the first 2 acts really, there was a storm. We had the risk of an implosion of our economy, crashing on the rocks, having deflation. And so there was Ben Bernanke strapped to the mast, trying to avoid the siren call of doing some things that weren't prudent and guiding us past that storm. And now we've gotten out of the emergency room, we are growing. It may not be the pace that people would like, but it's a positive sign. We warded off deflation. The next 2 acts into play, now we'll see what happens. We do have an enormous, what I consider to be, if we don't manage this correctly, and I believe we will, we have what I consider to be a significant pile of inflationary tinder. That is the excess reserves that have been set out there. And you have to remember, we're only 25% of the credit system, or less, maybe a fifth, because it's a very sophisticated credit. The depository institutions that park their excess balances on our balance sheet at the 12 Federal Reserve banks, now about $2.3 trillion. Think of that and multiply it by 5, and you understand how much liquidity there is out there. But we're the key fulcrum. And the key is going to be to make sure that as that money picks up its velocity, comes back into the economy, that the Federal Open Market Committee, which John and I sit on, which Chairman Bernanke used to chair and now Janet Yellen chairs, moderates that influence properly so it doesn't become an inflationary force. When I say tender, it's potential. You have enormous talent sit around that table, all of whom are non-politicized, by the way, and eager to get it done correctly. We are in unexplored territory. We know that. But the main thing is just to keep sailing the ship forward and making sure that we don't create inflation in the future. And that's what the exit strategy is all about. I know it sounds simple to say exit strategy. There are exit signs all around this theater. But, you know, and you have several options to leave this theater. And we've developed several options in order to try to control that flow back in the economy. Again, once it gets activated, and what's holding it back, in my opinion, is poor fiscal policy and total confusion on the fiscal side, which is not our business. We're on the monetary side.
Understood. I have a follow-up to this, but let me just say to the audience, we will be opening it up to questions momentarily. If you will just please start lining up by the microphones, that would be very helpful so that we could all hear you. So if you could start lining up by these two microphones, that would facilitate things much easier. John, you wanted to say
I just want to respond to something that I heard a lot this morning, and I understand where people are coming from, but you know, the Federal Reserve, we're not confused that we somehow have policies or that we're responsible for creating long-run growth or job creation. You know, our remit is relatively simple. It's to keep inflation low and stable, price stability, and try to keep the economy near where its potential is. You know, that's an unemployment rate near its longer-term trend. That's all we're trying to do. We're basically trying to keep the economy in a good place so that, or in a reasonable place. And of course, we recognize that the long-run growth, the true kind of, you know, supply side of the economy is determined by other policies. So I often hear comments like, well, the Fed is taking on too much responsibility. They're trying to do things outside their control. We fully understand that we can't do that. We fully understand that we have limited tools and a limited ability to do what we're assigned to do, but we also have a full commitment to do that. So I just want to kind of push back against the nature that somehow we're sitting there on Constitution Avenue thinking, well, Congress isn't doing their job, I guess we'll have to do it for them. We know we can't. We have to work within the confines of what we can do and just basically try to keep inflation low.
If I can just make a comment real quick. You know, you hear about the dual mandate. With Congress, dual is spelled D-U-E-L. So we know that inflation is a monetary phenomenon. We're obviously all schooled in that theory and understand that fully. As far as achieving full employment, again, we can only provide the fuel, and that's where the dual is, the DUEL. We are necessary but not sufficient.
But what is your response to what Kevin Brady said, who he basically said, look, I think the dual mandate is confusing. He's got this commission that he's pushing forward to change the role. What's your response to that?
I probably am a little bit different than John and some of my other colleagues. I worry about the second part of the mandate, but Congress gave it to us. It's part of the law. It's what gives us our license. And I do believe that if we focus on price stability, which, as John has pointed out, it's not an issue right now, it helps us achieve the latter. But there's a little confusion in terms of our capacity to affect full employment. We have to provide monetary conditions to make that possible. That doesn't mean we can solve the problem. The whole issue is lifting final demand so you have people demanding output from goods and service producers, and they hire more people to get that job done. We have a limited ability to impact that, and that's where I think the tension, it's not tension, by the way. We don't argue at the table. We're not like Congress where we beat up on each other. We're just trying to figure out the right solution, but that's the hard one. So I think he has an interesting point there. It should be debated, but I also think the better point was made. Do you want all those members of Congress to make monetary policy? They can't even, they're the gang that can't shoot straight. They can't even make fiscal policy.
Fiscal policy, right.
So I respect Congressman Brady enormously. He's a good Houston congressman, a good Texas congressman. But if you're going to have a commission, you need to have a broader composition of that commission than just having members of Congress who can't even get their own act together, in my opinion.
So, you know, back on the dual mandate, I don't think the dual mandate is in any way a problem. I think it's actually an honest truthful representation of how we conduct monetary policy. It's also the way, and I think Kevin Warsh made this point, there are a lot of countries that have single mandates, Bank of England, ECB, they all do the monetary policy basically the same as we do. They call it flexible inflation targeting, but it's basically the same notion that you obviously, over the medium term, want to keep inflation at a low level, like 2%, but at the same time, you lean against the wind. When the economy booms or goes into recession, you basically try to keep the economy on its, at full employment. There's really no significant difference in how monetary policy is conducted, whether you have a single or dual mandate. But I actually believe that from a transparency point of view and from an accountability point of view, that's the way we do behave. We do have these two goals. We explain our policies in terms of those goals, so it makes sense to have the dual mandate. I think when these countries you look at that have the single mandate but actually are looking at both of them, always have to kind of pretend they have a single mandate and they're not looking at the second, when in fact they are. So I actually think it works, but also I agree with Richard about, if we're going to have a commission studying this, I think it really should bring as many experts and things to have that discussion as possible.
May I just make one comment? I think Augustine Karsten's phrased it exactly right, which is you don't want your decision makers, your business women and men, and the people that employ and expand our economy and create prosperity, being distracted by inflation. We don't see that right now. Now, we did hear commentary of fears of the future, and that's up to the future FOMCs, open market committees, to make sure that that money is regulated, as it were, I'm talking about dials, as it flows back into the economy. But right now, you don't see businesses preoccupied with the accounting for price instability and so on. They're conducting business.
That's a really good point.
And I think that's an important point, and that's how you grow.
We're going to come to this question in just a moment, sir. Let me ask you this. How important are the moves in markets in terms of looking at your overall assessment of the economy and investor reaction? For example, it feels like the stock market is trading as if there are no risks out there. Everything is fine. We're near all-time highs in the stock market, and yet you look at the bond market, where just the other day, the yield in the 10-year hitting 2.48%. Is the bond market telling us something different in terms of what global risks are out there? We haven't really discussed an impact or the potential of a spiraling of Ukraine, Russia, sanctions worsening, Putin fights back, a disruption in the oil markets perhaps affecting Europe and then the U.S.
Do you mind if I take a crack first? Actually, one of the things that concerns me is there's almost no volatility in the markets. I don't think that's healthy. Governor Stein, one of our Federal Reserve governors, unfortunately, going back to Harvard University, escaping from Washington, has been speaking quite eloquently about. But I think this is a testimony to a couple things. One is an expectation that there will be continued low interest rates. Again, our current chairman has made that clear. After we finish the tapering program, which I'm delighted we're putting to an end, it's whatever function it performed. But there's an expectation rates will stay low. And secondly, I find it interesting that there hasn't been a harsh reaction to Crimea. To me, that shows greater stability.
And it's not priced in at all.
Well, the question is, I think the markets are much more comfortable with themselves. It didn't create, if this had happened 2 years ago, I think you would have had an enormous amount of volatility. But I think the real issue here is faith in the United States. I hear all this criticism constantly. And of course, my response is it's because Texas is still part of the United States. But look, people come here for safety. I think that's one of the reasons, if you took at the key earmark interest rate, which is the 10-year bond, or you look at the 7-year, you would have thought, if we're ending the tapering program, that rates would be up over 3%.
Exactly.
So it doesn't tell me, and maybe his enthusiasm is too infectious, but I see it in my own state, in my district, and I do think the economy is moving forward. It doesn't say to me that the economy is about to implode.
Yeah, I agree with that. I think that the important thing to remember, though, when you look at the stock market, I'm just going to repeat a point that's been made before, but the stock market's rebounded dramatically from very low levels after the financial crisis, when there was just a question of whether these firms and many of the biggest companies in our country would survive. So when I look at the stock market today, I don't see it as being overvalued or somehow out of line with fundamentals out there. I do think there's a serious question out there, and Larry Summers has brought this up publicly, and a lot of people are debating this, is what's the long long-run kind of interest rates for the global economy. After the Asian financial crisis, we saw what Chairman Bernanke referred to as a global savings glut. The global financial crisis is basically probably reinforce that. There are a lot of countries around the world are piling up massive amounts of treasuries. There's a lot of saving for basically protection or building fortresses from another crisis. And so a fundamental question I think the bond market is struggling with is what's the new normal for interest rates? In the past, a normal 10-year bond, you might have thought might have been 5 or 6 or 7%, but clearly, the global economy's changed. And one of the big questions out there is, where's, in the end, it's about investment versus savings, and what's the balance, what's the price that will balance that out globally? And I think that's one of the factors out there is in the future, are we in a future of a slower growing global economy, lower population growth, lower growth abroad, and maybe lower long-run interest rates. And I'm not taking a stand on that, but clearly it's something I see being kind of at play in the global markets.
Yeah. Sir, question.
Mr. Williams, I was going to follow up on your comment about how dynamic the real estate market is in California because of the job growth, but you made no mention of record low rates affecting both cap rates to all-time low and their financing costs being all-time low. And to me, that's problematic as far as the issues that we face because we're all trying to spot bubbles when maybe the reference rate that we're all looking at has been controlled because of the record monetary conditions.
Sure, I think it's absolutely true that very low interest rates, one of the channels it affects the economy is through lowering the borrowing costs for investment for businesses, including on pricing of commercial real estate. What I'm seeing in commercial real estate, I'm not just talking about the prices of office buildings. I'm talking about rents on apartments. I'm talking about, occupancy rates. And so I would argue that beyond the point you're making, which I think there's truth to that, clearly low interest rates are stimulating the economy. That's what it's supposed to do. It's supposed to help add to growth. What I'm seeing is just much more broader dynamic in the economy. And if you're going to ask me, are we going to go through another real estate cycle in California in the future? The answer is yes. When it will happen and how it will end, who knows? But that's the history of my great state.
Thank you.
Question there?
Yes, I'm Scott Orr with Fidelity Investments. The FSOC and SIFI designation and issues and now discussions about perhaps asset managers being included in that analysis in an OFR report that came out recently. I'm just curious what your thoughts are, or if any insights, and is this a train that's left the station because there's just not a lot of congressional oversight of what could pull back on that?
It's a really important question because people are wondering why asset managers would be deemed systemically important.
I sort of have a problem with the designation, SIFI, systemically important financial institution. Sounds like something you pick up after bad behavior at a bar or something.
And then there's the GSIFI.
That's right. So
That's even bigger.
But the fact is that we do have systemically important financial institutions. We'd like to reduce their influence. And they also, as you know, the Federal Reserve has been quite aggressive in terms of insisting on liquidity standards, capital ratios, et cetera. In fact, we've been far more progressive on that front than, say, the International Convention under Basel III. Now, that's for people that take risk with the public money, depositors, depository institutions, and others who might be placing the taxpayer at risk ultimately. I will say, and again, I don't have anything to do with developing these policies. I'm a Federal Reserve Bank president, and it's not the Federal Reserve is eager to claw their way into money managers. I don't understand why, if they're taking risk with other people's money who have studied what they do, but it's not taking risk with taxpayer money. It's not federally insured deposits, for example. So personally, I don't get it in terms of the question of someone who's in the money management business asking about money management. All of us want greater financial stability. To me, that's systemic overreach by the regulators. But I do believe that we should be very, very cautious with those that we provide federal backup to, institutions that are too big to fail, and we have to then bail them out. I never, again, want to see us place taxpayer money at risk. I think that's what this is all about. And I don't understand how it extends to some of these money management firms and other firms like that.
Do you understand how it might extend?
So I'm not going to get, obviously, I don't have any responsibility around these designations either, and I don't want to get into the particulars of that. But I will say, let's go back to 2008. I'm going to get back to the taxpayer dollar at risk. Who are the companies at the center of the financial crisis? They're Bear Stearns, Lehman Brothers, and AIG. I mean, others too. Those companies where nobody was supervising or regulating them for safety and soundness. They were regulated by either the SEC or state insurance commissions and things, basically on the microprudential issues or consumer protection or other things like that. One of the lessons of the crisis is we have an incredibly intertwined, interconnected, complex financial system that even if you're outside the regulatory, if you're not a depository institution like Lehman Brothers or AIG, you have the ability to create enough explosive danger to our financial system that you can actually bring down the financial system and throw millions of people out of work, essentially. So I think that the greatest accomplishment in terms of creating the FSOC is to allow for an opportunity to take firms that are in the shadow banking system, outside depository institutions, and if they act like banks, they behave like banks in terms of their role in the economy, and they do pose risks to the U.S. economy and the financial system, that they be regulated as such by the Federal Reserve. Again, I'm not referring to the specifics here, but I do think this was one of the major important changes that Dodd-Frank did. And the other thing I'll just mention, just because of the earlier panel, we were talking about a lot of people criticizing Dodd-Frank, but I think it was Steve Friedman, but somebody made the comment, says, well, the good thing is we are demanding more capital, more liquidity, and we're doing stress tests. And I actually think those are the critical parts of, maybe Dodd-Frank is too complicated, maybe it has a lot of things that people, don't like. But in fact, it does have some key aspects that I think are critical to having a more robust financial system, because I agree with everybody who said we can't predict the next bubble. I agree completely with Steve Friedman that we're going to have another panic at some point. What we need to do is not create a system that solves every problem. What we need is a financial regulatory system that makes it strong enough that it can survive the problem that we didn't foresee.
I rather like Steve Friedman's quote, because he quoted me. I thought that was pretty good. Shows he's a very good diplomat. This is where Act 3 and 4 will be written. Again, remember, our charge formally has been depository institutions. That's now a fifth of the credit system. So this is another thing that deals with the future of the Federal Reserve. How far do we reach? What's our responsibility? What's the public and the Congress expect of us in order to ensure financial stability? So the question really is asked against that background. We used to have, in the old days, particularly when the Fed was created, it was 100% control. We don't. And I think it's commonly viewed that we are the most reliable, constant force. Again, 100 years of practice. Yes, we could review that if it's done responsibility. But here's the point. It's only a quarter or a fifth of the credit system. And that will help us figure out, as we go forward, since we interact with so many, what's the limit of our franchise, what's the role we're supposed to play, et cetera.
It is, unfortunately, we are out of time, gentlemen. I'm so sorry that you will not ask your question. As we leave the stage, just give us two items. Where is the growth in the U.S. right now? Can you name a sector that you think is the low-hanging fruit, that is really where the job creation and growth in the economy is today? Don't say Dallas.
All right, I'll say Texas.
No, a sector. Can you give us a sector?
Sure. I mean, we are the leaders of the world in terms of high technology and IT. That's where we lead. And
I think there's a revolution in biotech
and in energy as well. We're seeing it.
Gentlemen, thank you. Richard Fisher, John Williams, thank you.